Everybody. My name is David Logan. I'm one of the partners at an accounting firm called Logan Katz. Thank you for joining me today as part of our fall 2020 webinar series on planning the catch. Today it's on cash flow forecasting. We've got an hour together, and I'm going to go through some PowerPoint slides and an Excel-based model for a forecast. Assisting me today is one of our staff. Stacy is on the call with me. So if you have questions, please type them into the chat box. She will bring the questions to me, and I'd rather respond to your questions as I go through. But if you want to leave your questions to the end, feel free to do that also. The Excel-based model that I'm going to be presenting, you're welcome to a copy of it also. So please send us an email after the webinar. We'll send it to you. This webinar is actually a 1 hour condensation of a 2 hour webinar that I do on this exact topic with Invest Ottawa. And so if today's session is too brief or you want a refresher afterwards, if you went to the Invest Ottawa website, you'll see various events that are hosted by other firms, including ours, and you'll see this webinar. It's presented about 3 or 4 times a year. What I'd like now to do is to share some slides with you and get underway. So as I mentioned, as part of a fall series, we plan, because of the COVID restrictions on all of us as humans and on our economy. If you're attending the call today, you may be a business owner, and this is one in a series of events we've got to help people think about ways to adapt to the pandemic. And one of the issues that comes up for all of us, no matter pandemic or otherwise, is your business and cash flow. So today I'm just going to touch on 3 topics because it is about an hour only we've got. So the importance of projections. If you're attending the call, you've probably determined it is, and I'm grateful for you attending. I will go through the components, and in that component of financial projection portion, I will then switch to the Excel model that I referred to a few minutes ago and show you how it works and some of the features of it. And then the latter topic is selected topics for discussion, all again regarding cash flow, things to think about. I don't read the slides because you can read them. But in terms of any period of time, but especially during a pandemic, when many things are interrupting your business, one of the items you don't want to have a lack of control over, or at least an understanding of where it's going, is your cash flow. And the first topic, saying why businesses fail, seems very negative. Flip it the other way around. Good cash flow control is how many businesses don't fail. Anytime you're in business, whether it's pandemic or not, you're going to need cash. All of us need cash to hire the proper staff, to buy product or services we need, pay rent, maybe pay off a bank loan, and things of that nature. What I'm looking for in terms of the projection is to get some advanced knowledge of what's coming up. And so the projection process, if we're talking about it today, it's in November. The projection is probably being done today. You're probably going to be doing it throughout the month of December, January onwards. It's an ongoing process. In terms of the very last item on the slide, it says in the initial years, a business may not have cash reserves built up. You may have built up the cash reserves. The pandemic may have brought down your reserves. If you've been shut down since mid-March and opened up periodically as conditions and regulations allowed, you may have seen some of your cash reserves decline. If you are in a startup period of time, well, then you don't have those cash reserves. It doesn't really matter which of those situation applies. It just means that you still need to apply the cash projection philosophy to try to get a sense of where your business is going. Identifying the cash shortfall. So the whole purpose of a projection is to take a position today and say, where am I going to be? In a little while on a subsequent slide, I'll talk about a 12-month period, but for sake of discussion, thinking out 12 months is to see where are you today in November of 2020 and where are you going to be, let's say, by October of 21. In that 12-month period, you're going to have to get some guesstimates, and I'll come back to those, on various things. The hardest one typically is on revenue, and I will touch on that in more detail, and the expenses side. One of the issues that comes up on the slide, the fourth item down, I think it is, it says reassurance to investors. I always want to remind yourself that you are an investor to your own business. So even if you don't have outside investors, maybe you're the only shareholder. If you have outside shareholders, outside people, then it applies. But never forget that you yourself are an investor to your business. So you want to get an understanding where you're going with your business, to be able to make good decisions, to get comfort that you're going to be able to survive into the near future. Financial control, third item down. The projection process is to give you financial control, and that's probably the biggest issue that we as a firm have ran into this year with our clients during the pandemic. Many clients felt they were out of control, and rightly so. They literally could not open up. They were prevented from opening, and or they had restrictions imposed upon them. They couldn't do some of their travel they need for business, let's say. And again, some of their customers and suppliers weren't interacting with them because they themselves were having their own issues. Some of their staff wouldn't attend through our clients' businesses because they felt they were at risk of contracting COVID in the workplace, and so they withheld their services. A very, very difficult time for anybody in business, including our own business, where you're dealing with situations that really are generationally not been seen before. But yet we're all here in November 2020 having to deal with it. The projection that I'm going to talk about today is really to focus upon that you're going to have to change often some of your major assumptions, and some of those changes will be thrust upon you, meaning that if there's a tightening on restrictions and we all have to shut down to a higher level of restrictions than currently we enjoy, that'll affect your business. You can't really anticipate that will happen, but you have to anticipate the financial consequences if it was to happen. And that is probably the biggest part of why we want to do this series in the fall, is to combine topics that we've seen with our clients in the last 7-8 months since the pandemic really hit around mid-March, how people have reacted, and pass on some thoughts on how to possibly get some control. I'm going to talk a few concepts here, and again, I don't know everybody on the call, their background, so I'm just going to give some highlights. Whenever I talk about financial projections, I'm really talking about 3 financial statements. And the statements themselves, if you're not familiar with business terms, I'm just going to go through briefly a summary of what each is and why they're called. So there's an income statement, a balance sheet, and a cash flow statement. That is the core components of your financial projection. And if I define it this way, the income statement is basically a recognition of your revenue you get from customers, less the expenses it took to get that revenue, is your net income. So the income is the excess after you have revenue in excess of the expenses. A balance sheet is an equation of assets equals liabilities plus equity. An asset is something of value to you. So if you have some money in your bank account, let's say $10,000, that's your asset. A liability is money you owe to someone. So if you owed maybe $2,000 to a supplier, that's one of your liabilities. The equity is the residual. So assets equals liabilities plus equity. If I had 10,000 cash, I had a $2,000 liability, I've got $8,000 of equity. And then the third one, the cash flow statement, really draws the two together. And I'll try and give an example. So if in your business you were to sell to someone, so you had revenue, but you both agreed that that person didn't have to pay you for 30 days, on your income statement, you'd have that sale, but you wouldn't have any cash. So at the end of the month, you know you've had a sale to someone, but you wouldn't have any cash. And you say, well, what do I have to pay my employees, my suppliers, my landlord at the start of the month, next month, because I don't have that cash. Because effectively, yes, you had a sale, but that money is not cash, it's an accounts receivable. It's an item on your balance sheet. So the cash flow statement, again, in this Excel model, which I'll show in a few minutes, brings it together. Some of the decisions we all make in business on how we run our business to say, well, I'm going to start selling, but accepting credit terms, asking people or telling people they can pay me in 30 days. It's a valid approach, but it does have cash consequences. The assumptions, and this is where I'd like to spend a few minutes. Every item on your financial projection, revenues, expenses, you're going to have to get some assumptions. And how to get those assumptions, you need to do some research. If you've got industry knowledge, if you've already been practicing in your business for a number of years, you probably have a lot of information already. If you're starting up, you're going to have to go to other sources to get that, and I'll come to that in a minute. And then finally, on a projection, the sensitivity analysis is to say it won't go as well as we all think, and it won't go as badly sometimes either. So when you do it using a software such as Excel to do a projection, I'll show you how to do it. You can build in formulas to vary your revenue. So if you think you're going to have 10,000 revenue in the month of December, you would say, well, what happens if I only have 8,500 of revenue? Or if my expenses go up, let's say your labor costs are going to be higher than anticipated, you have to have more people to deal with COVID conditions, you're going to have a need to vary that expense and increase it. So sensitivity analysis is something that when you're doing your projection, you're constantly looking at the inputs to what you're putting on the projection, as well as the variances on it, sensitivity. So this slide talks about realistic assumptions, and I just finished saying what a tumultuous time we live in. So the realism on your assumptions will be based on our best guesses, and so as all things go, on your assumptions is to document. Again, within the Excel document I'm going to show you, there's a tab for assumptions. I would literally type out what your assumptions are and put them down. And why you do that is help you document for your own purposes what you thought when you originally made your projection, and you start to update it, you want to change your assumptions. How do you get help with these assumptions? So I mentioned if you're already in business, you probably have prior history, you've got some financial results in prior periods that'll help you determine at least what you think could happen. If you're in a pure startup mode, and people are starting up at this time in pandemic, which is really amazing to see as a business person when they come to us. So if you're on the call and you're one of those people, kudos to you. So whether you're starting up or in industry, business already, you're going to get a variety of sources of information. So the startup period, you might do industry research and find where demographics are for people that may want to buy products and services. We've seen clients use that. That's more for a fixed base operation for some of the retail services people might buy. Using advisors, and this is where I do put a bit of emphasis at the webinar. You want to talk to people beyond your own family. Your own family and friends typically will validate all of your assumptions erroneously, is what I usually say, because if you're thinking that sales will rebound in December, your family and friends will probably wish you that they do, which is nice. You need that support, but you probably need to talk to other people that will at least critically look at your assumptions and say, have you thought of this, consider that, or something similar. The reason I mentioned lawyers and accountants, depending on the level of work you're trying to get research done, there are two groups of individuals professionally that can't divulge what you're going to tell them, and that'll be important if you've got information that you view as being private and you don't want to have divulged that could cause some sort of loss of competitive edge for your business. Lawyers have confidentiality as well as privilege. Accountants have confidentiality, meaning that if you came to us as an example, Logan Katz, if you're to show us your financial projection, we can critique it, but we can't tell anybody about it. And that's of huge value from time to time when you really want to have someone look at it who can't divulge it. Then you have to start reaching beyond those groups. And that's where I use the concept, share the information as much as you would with a potential customer or a potential employee of your business. Often you'll want to talk to other business people that you compete with that might be in your industry sector. People, how do they do that? They do that at a variety of business groups, such as Kiwanis, as an example. Kiwanis is a business group. People get together. They're almost always business people or people in the business community. Bankers, I very much enjoy conversations with bankers. I recommend clients talk to them also. Bankers see a lot of deals and they see a lot of business. So going to a banker, establishing a relationship with your business banker is important to get some critique on it. Again, what I'm asking you is to try to get as much information as possible from people that A, will be critical of you, and then you as the recipient of that information, try to take it in the way it's provided, that people generally are going to want to help you. And knowing that when people say, I don't agree with your assumption, take it in the way it's given, that they're saying there may be an error in your assumption, or your assumption may need more discussion to make sure you're on the right condition. In the past, I've had clients where one fellow came to us many years ago. He relied upon traffic counts for setting up his business, which was a coffee franchise. And the traffic count where he was very strong, but the traffic count was for people traveling by where he was thinking of locating. He didn't really have a statistic for the conversion rate of someone going by to coming in and buying. And in his particular case, when we did the projection with him, we recommended not to proceed because we couldn't get a sense that there would be a conversion rate where he was located, and there was no competition in the area he was in, and we felt that was a weakness, that him setting up would probably attract others. And as it turned out, that is what happened. He couldn't get people to get out of their cars in the cooler months in the fall, and certainly the winter months, because it was an outdoor mall. You had to walk up to the location. It didn't have a drive-through. And then once he set up, other businesses of another franchise, a coffee franchise, set up with a double drive-through window to give the detail to it. And unfortunately, he wasn't able to continue. So I use that as an example to say where, very good information statistically, you have to sort of sound it out to someone. Sometimes you run into people too where their competitive edge is foreign exchange. We have a lot of clients, and I've seen it over time, where the Canadian dollar is again in a position where it's discounted to the US dollar. So the strong advantage to selling to the US market, if you've got Canadian costs but American dollar revenue, you're getting a win. Around 2011 or 2012, if I recall, exchange rates were pretty much on par, and I had different clients around that time which realized a significant drop in revenue and in income because all of a sudden the competitive advantage for the American purchaser wasn't there anymore. And so again, it's the assumptions. You're saying traffic statistics, foreign exchange. It's really just that benefit on your assumptions to think about what could change. Again, not to stop you from going forward, just make sure you've got enough information. Sensitivity analysis, the reason I mention it again is almost always, including our own business where we still do financial projections, the sensitivity analysis is to say, what happens if? And the common one I'd like to suggest is, discount your revenue, increase your costs by some factor. And if someone said, well, how much? Take 10, 15% off revenue. And just to start, just to see what it does to your ending cash position, to know how vulnerable you may or may not be. Common problems that I've seen too, including our own business, very optimistic on sales. That's good. It's good we're all optimistic. If you're in business, how else are you going to start a business if you don't have some degree of optimism? So when you're optimistic on your sales, is make sure you've got some detail behind it. So many years ago, we worked with a company that was in Nortel's group, and it was going to be spun out, and it was successfully spun out. We ended up doing a financial projection for them. There was about 140 assumptions, very detailed assumptions, very specific. And here's where I'll dive into a bit of the assumptions. What you want to do is specifically say, who is your customer? How often are you going to sell to them? How much are they going to buy? And how frequently? And when we did the company that left Nortel, That is exactly where we spend time on the revenue cycle, trying to determine what is the likelihood, and there's a concept of the cost to acquire a customer. What does it cost to acquire a customer? You may have a long pipeline. If you're selling, anybody in this call, you might be selling to larger businesses. The end play might be you're going to get significant revenue, but they usually have processes fairly strong to vet out purchases because they're a bigger company, as opposed to a small company will buy less from you. But normally you're dealing with an owner manager, perhaps even directly, who'll say, yes, I'll buy from you, your product, your service. So two different customers, two different outcomes. One, the institutional type larger company, much bigger sales volume, but longer pipeline to get there. Still worthwhile to pursue, and probably a different play in how you're going to do it. Whereas, if you need to get cash flow in soon, you may end up saying, well, I'm going to deal with smaller companies and have lower unit sales and higher volume, but I can get the sales going right away. The sales cycle will be different for everybody on the call. If you're starting a business where it's got a fixed base location, it doesn't matter what type it is, a garage, a restaurant, yes, I'll say, whatever it may be, or store or retail, very different than if you're a service-based business. Maybe you're a software provider and you develop something and now you're selling it through the internet. We have clients that sell on Amazon. So again, retailers, but not selling it in a brick and mortar location. They're selling it through the Amazon brick and mortar. All of those have different methodologies to get sales, to understand what you're going to need in terms of cash. So if you're an inventory-based business, such as a store, even a restaurant to some extent, to get food and beverages in, you're going to have an outlay of cash up front before you can actually sell to a customer. Whereas a service-based company, normally, you've got your team, you're paying for salaries, but you're not actually paying for product to be warehoused and shelved someplace. And costs that are higher than expected. Again, I think COVID has shown us all that if you're dealing with a fixed base location, a lot of people are finding that revenue sources are down because of social distancing. And then they have to expend more money on all the protective equipment and gel, et cetera, that we all need to have to keep everyone safe. So, and that's not something I would have predicted back in January, February of this year. Business changes, so it's really to say that anticipate that some costs will be higher than expected, and you may have to react to it. I'm just recommending that if you're going to do a projection, use some sort of a software-based tool. I'm going to go to the Excel model in a second. I like Excel. It's well known. Formulas can be done in many different softwares. What you're looking for, I think, is something that you can use. Who's doing this projection is probably yourself. If you're on the call, maybe you're a business owner, maybe you're the accountant or controller for the business owner, but whoever is doing the projection should have a tool, the software that they're most comfortable with. Don't try to, implement a projection process on something you're not comfortable with. I always mention 12 months. I think 12 months is a realistic projection period. I think there's a high certainty for all of us to know what we're doing in 30 days. So today's the 12th of November. December 12th, I suspect most of us could probably say with some certainty in the next 4 weeks what we're going to do. From a business point of view, I'm talking about 60, 90 days out. We're into early 21 at this point. There's some certainty to that. And that, again, is dependent on a lot with the COVID conditions. If you start going out to 12 months, and that's a realistic projection basis, November of 20 or October of 21, let's say, I really don't know where our business, Logan Katz, will be in October of 21, but our projection process will take us out that far. But all I'm suggesting to you is the clarity will be, you'll have much better understanding of the 30, 60, 90-day window than the 12-month period, but I am recommending to do a 12-month projection. I'm going to just switch to the Excel model now. I thought this is the document we're glad to share. This is what we share from the Invest Ottawa seminar too. So it is an Excel-based document. I'm just going to quickly go through the tabs. For various reasons, we color-coded the pages just to make it easier. the income statement I'll focus more on in a second. Cash flow statement is the linking document I talked about, because I talked originally about an income statement and then a balance sheet and the cash flow statement linking it. I'll show you what I mean by that. And then an assumption page. And I'll just specifically talk about assumptions. This is used in a presentation at Invest Auto, as I've said a few times, in a 2-hour period. This model was actually, this Excel-based financial projection model was actually used by a tech company in Ottawa. And we were given it around August of 2012 by Invest Ottawa to format down for the presentation we do with them and for yourself on this call today where I'm using it. So the assumptions would be much more numerous. That's what I'm coming to. The assumptions are brief here, just to show you that you have to have assumptions. And again, if you're familiar with Excel, you would link in the sheets from various tabbed sheets back to each page. I'm just going to go over a couple of topics, just high level. As I mentioned on the balance sheet, assets equals liabilities plus equity. So just in case you're not familiar with what I'm talking about, in this case, there's about 51,200 of assets, 55,000 of liabilities. And so the company's got a deficit, in this case of 3,800. It's got more liabilities, more money owing to people than it has money or available resources such as receivables. What I want to spend time on is on the income statement, because I think if I was attending the call today, I'd want to know, how am I going to look going forward? So start with your revenue line, link it back to the assumption page, put your assumption in, and it doesn't matter what type of business. So whether you're selling a product or a service, both lines that are here are just placeholders. Put as many lines as you want, put realistic amounts of detail to what you know. And this is where it's hard when you're doing a projection, because it often will come up with frightening results. It's going to show you that you're losing money, but I'll come back to that in a few minutes to talk about that. Put your best guesses, best documented guess down using the assumptions of where you think your revenue sources are going to be, and put as much detail on your assumptions. Again, if you're in a startup mode, you probably don't have any history. So if you're in a startup from an industry which you're already practicing in, possibly as an employee, use your employee-based experience of your observations to try to say how you think you'll deal with your new venture. If you're actually setting up a business from something you've never done before, it brings me to a bigger discussion, is probably bring someone else into your business that can help you with it, someone who's been there, done that, because you're going to need someone to assist you, to really help you see where you're going. If you're otherwise in business and just trying to navigate the COVID world, as we all are, you've got that history. And so what I would look for, how did you do seasonally a year ago around this time? How do you think it'll affect going forward? If you're in an industry which has no pattern, construction is one of those. Many construction clients we have are project to project based. If projects aren't there, or they don't win the bids for the projects, they don't get the work. You're now down to try to estimate your pipeline of projects you think you'll get and the likelihood you'll get them. So it's at that detail level across a couple of different scenarios I gave, where you would fill in the revenue line. The salaries and expense line that are below it, those are usually easier. If you're in startup mode, if you're renting from some landlord going forward, you're going to have a lease. You'll know some rent subsidies that are available now. Our website has, by the way, a lot of information. We have a COVID-19 dedicated page with lots of resources to help you see what programs are there to access. Coming back to that for salaries then, if you're in business, you're probably aware of it already and may have accessed the CEWS, the wage subsidy program. It's continuing into 21. You'd want to put that as a possible source of cash flow to your salaries. In terms of other expenses you're going to have to put down, from an assumption point of view, again, what you're looking for is to have enough information on your assumptions for the expenses. The categories that are here, again, I use the term, they're placeholders. This is from a presentation, as I mentioned, so these are meant to only to show categories, but I'm going to go across on the screen just to show you what I view are common problems people put in, and I'm going to just come to you as the person. Management salary. So I should have mentioned this presupposes a corporation setup. So if you're a partnership or a proprietorship, you wouldn't have salaries. But in this case, assuming it's a corporation, never forget to put your own needs in on your projection. That is something that if someone does bring me a projection, I usually critique it to say, how much are they going to take out? Because no matter what I've heard from people saying, I don't need much money to live, everybody needs money to live for something, some purposes, to pay living expenses. What I'm proposing is on this model, and this model was set up particularly for a reason to show the errors that people do make. I would say, be honest with yourself and put in what you're going to need for salary. If you're a proprietor or a partnership, a partner in a partnership, then you, instead of salaries, it's your draws. Draws are the money you take from your business, but it's the same issue. Like, absolutely don't forget that you're part of the business. Again, coming back to my earlier slide, you've invested in your business. You need to put that in. You're going to need the money out. There's a variety of expenses that are shown here that, again, even though they're placeholders, it's more to say, think through your service delivery or product delivery, what you're going to need. COVID has shown a lot of surprising issues. I don't think anybody put a lot of money into plexiglass dividers and hand sanitization, et cetera, for most of our business, and our own included. So COVID has brought out a number of surprising expenditures. You may have staff that are working at home. Maybe you've had to go into cost to get them set up at home, whether it's hardware and software solutions to get them to be able to assist you in your business. It may be you have to hire extra staff to deal with your customers when they come in for the COVID conditions. So again, it's to really think it through. And as conditions are changing, none of us should be faulted for saying, look, I didn't think of that. Again, the whole purpose of a projection is to put in numbers that you think are realistic, documenting it, and then acknowledge the fact that it might change. Again, what I look for on this sheet, if this process is being done today in November, and maybe the first month, it says January, but for sake of argument, this could be the month of December of 2020. And this would go to, let's say, November of 2020. If you look at this projection, it's very dismal. This is this model I use when I do the 2-hour presentation. It just shows consistently that the business doesn't make a lot of money. And then it goes back to, in the projection process, is to say, what can I vary to keep myself into positive cash flow? Positive cash flow is where you're aiming for your business at all times, pre-COVID or otherwise. So what you're looking for is really to see, if you're losing money every month, where's my cash at? So then you go, again, these are linked spreadsheets. So this particular business on a sample company that we set up for the presentation, it starts with the amount of cash that comes in from the owners of the business, where my cursor is at $55,000, the owner, and it's money either from himself or herself and from family and friends as loans. So at the end of the period, you can see that they're putting 55,000 in, they're losing money. Now it's down to 40,000. It goes down to 30,000. The company's losing cash every month because it's losing profits every month. It's got losses, not income. This is the linkage of the spreadsheets for, if you're projecting from the income statement, to see what your assumptions mean on the cash flow. What it might mean is that from time to time in the next 12 months, you on the call, our business, may have to go for financing. So we all are aware, if you're in business right now, they put in place, the federal government and the province has put in measures. So as an example, there's the SEVA, which was a loan that got expanded recently. That financing is a loan with a grant component that you get to keep. But the concept is, by looking at starting with your income statement, putting your assumptions on revenue, your sales, your expenses, and flipping to what is your cash, seeing what can you do to help you get from here till 12 months from now. 12 months from now, I'm not saying is the end of COVID. I'm saying that's just the projection period. And when you look at it, again, on the balance sheet, you can see that this case, again, this is a hypothetical business, but the company started with $40,000 loan from family members. Well, ended up having to put another 40,000 in the month of May. Again, I can only preface this or describe this document is from a 2-hour presentation where I actually go through a case study and I populate all these numbers into it. But I can tell you that's what this model showed, that this company, whoever was setting it up, was saying, I'm going to need money from somewhere further into the year. That's not a bad thing. If you're projecting out saying, I'm going to run the company today, November of 20, but by April of 21, I'm going to have to put money in. And maybe you've already identified sources for that money. Maybe you've got an unused line of credit personally. Maybe you're aware that you've got an investor, another shareholder, if there's more than one of you in the company, are prepared to put money in. All of us are in a period of time where we're trying to understand how do we get from here to a success in the future. The game in business typically is to get cash from customers. Cash from customers keeps all of us going. And in the near term, where your customer group are compromised because they themselves don't want to make purchases, they're purchasing but in reduced quantities, so not the amount you need, is to look at how can you get from here to there, and converting your cash they have to keep putting in back to accelerated or increased cash from customers is what you're going for. But again, that goes right back to dealing with the COVID conditions we're all in. You may be in tight conditions from here, as we all might be, for some period of time into 21. Things may ease, maybe they're easing now, I'm not sure. And then you might be in a recovery period where you may find that if you've survived, and I hope you do, I hope we do, and then some of your competition that was there pre-COVID won't be there to compete with you, and you may find you have a larger market share. This will be a huge opportunity potentially for you to expand your reach to other customers, to expand geographically. So the message would be is to project out with realism, and then as you're going through the subsequent months, as I briefly mentioned, you want to go back and change some of your assumptions. So if you're finding that the COVID conditions are continuing to be very restrictive, you're not getting anywhere near the sales volume you need, and your costs of operation are much higher, then vary your assumptions and change the numbers. When you're seeing the numbers getting worse and you're seeing that your cash flow diminishing, that's when you have to have a strong discussion with yourself about your business, saying, how much are you in for? How much are you prepared to put in? And a couple of cautions would be is, don't get behind on some of the things that can cause all of us grief. So if you're in business, most likely you're well above the 30,000 threshold for HST, GST, and QST. So absolutely make sure you remit those amounts. Those are viewed as trust monies by the Canada Revenue Agency. If you've got employees, you are required, as you know, to withhold money from their pay for income tax, CPP, and EI, and you have to send it to the government. Never vary from sending those monies in. You don't want to get to a situation where you have Canada Revenue Agency pursuing you because they have latitude to pursue you for those under the Excise Tax Act and the Income Tax Act as a director. And so my caution on all of this is it's not on the this model, but it would show on your balance sheet the amounts that you owe for those type of the undercurrent liabilities, HST and deductions of source. They would be outflows here somewhere as a category. You would add it in to make sure you're paying those amounts. So that's my caution to say, going through, add in your assumptions, be realistic where the cash position is going. If it's deteriorating, rethink where you're at. Keep in mind that you're keeping current with your deductions of source and HST. I'm just mindful of time. We've got about 20 minutes to go, so I'm going to go back to the slides. was right there. The second item down, I've already talked about it. So I'm going to deal with the first one. In a time of, even if it wasn't COVID, your business model, try to justify what you're doing. So if you need new equipment, consider leasing as opposed to buying equipment. So if you needed extra equipment for your staff at home, it might be late because I realize you may have made decisions already, but going forward, uh, try to preserve cash flow. Look at the utility of what you need to run your business. And often leasing equipment is far better than buying. So if you had to buy a computer for $4,000, let's say, and the peripherals to go with it, monitors, $4,000 out of your cash flow today, versus maybe a lease payment of $250 a month for a number of years. $250 this month, I'd rather spend than $4,000. The differential of $3,750, I can use to keep it in the bank to help me survive a period when sales don't follow what I thought would be my assumption. I mentioned insurance. Just if you're coming up to a renewal period for insurance, often you may find liability insurance. You pay $2,400 a year. You can pay that monthly. And they'll charge, the insurance companies will charge a finance charge. It's interest, it's deductible for tax. Again, always looking to preserve as much cash for the near term. Comparing regular projected amounts to actual. So it's a hard look at yourself when things aren't going well. And the optimism part, which I still say, good for you to be in business because you have to be optimistic, but be realistic too. So if you're just not getting the level of sales you thought, be realistic and say, I got to bring it down to what I'm getting, and how can I get it back to where I want it to be? Maybe it's different marketing. Maybe it's not possible because of COVID restrictions. It will happen, but it won't happen soon. And again, if you're in the enviable position of the fourth point in the slide, if you're in a positive cash position now where you've got good cash results by this period, my own caution is, again, take out the money you need to live, but I'd leave the rest available for business. These slides were done pre-COVID, but it becomes more evident now for all of us that we really don't know where the COVID situation is going, and the effects on all of us, whether, as I mentioned, it's your staffing, it's your customers. Your customers may want to buy from you. They just don't have the confidence or the ability to buy from you right now. You probably still have a valued contact, a valued pipeline for future revenue, but you're not going to get that money from them in the near term. Having that cash set aside, knowing that you hope to convert that dormant customer to an active customer, you need to keep some cash aside. So I won't keep dwelling in the one point, but making a desired effort to really put a halt on non-discretionary expenditures, and you've probably already done that, and preserve the cash. Our last slide is just some contact people at the office. Again, I mentioned our site for COVID support systems that are available from the various government levels, as well as the Government of Canada site. So if you're in business, again, and if you're dialed in today to this webinar, my desire is to say, absolutely reach out and try to get a wraparound of as many of those programs to get you surviving into 21 and 22 onwards. We in our business are lucky enough to see a lot of different businesses, a lot of different business types of different sizes, and I'd say there's a general pattern. There's people that are able to navigate the COVID conditions because they weren't shut down, and those are on a path probably to take advantage of the programs they've got in place and manage the results, access CEBA, perhaps talk to Business Development Bank because they are a strong lender, as are your own charter banks. The ones that have been shut down, they've had their challenges, and again, with the knowledge that there's government programs available, if I was advising for one of the shutdown businesses, in many ways, your revenue world has changed for no reason other than it did. It is nothing that you could have predicted, obviously. So going forward, it's a harder task to estimate where your revenue sources are going to come from. So if I owned such a business where I was shut down, I would probably look at the sustainability of some of the programs to keep you on your base costs you need to, whether it's key staff members, if it's rent obligations, a bank loan, and try to stretch out as far as possible. Look to your own resources, because a lot of time people have personal resources, whether it's an unused line of credit I mentioned earlier, but take a measurement of where you're at to see, are you sustainable going forward? It's a contrary to the whole optimism point I'm talking about, but at some point you want to have a discussion with someone to say, you know, is this a viable business going forward based on where I'm at today? And often that could be, yes, there's various mechanisms. You may end up saying, look, I need to get someone else to join me at the, assuming it's a corporation, get someone else to join my business who can see that there's a future. It may be an opportunity to exit. It may be an opportunity to exit your business, saying that, you know, that I'm not prepared to put all of our, an example, you might say, I'm going to cash in our RSPs, put a larger mortgage on your home. You may feel, I don't want to go all in that way. I'm just looking for an orderly shutdown. There's so many different variations in how this could play out. When you were to talk to, it doesn't have to be us, but if you talk to people about it, don't be afraid to look at your options if you're in one of those industry sectors which have been shut down, because again, what I'm looking for is to get you information. Often I find hard conversations of what I've just sort of prefaced, they're uncomfortable, but it's better to have it now than down the road where a business continues not to be able to recover and you've gone all in. You've poured in some money from RSPs, you've mortgaged your home further than you wanted to. At that point, you know, you have less of a recovery position as the business owner. And so it's not a common conversation to have when I do a financial projection webinar, but I thought before today's session, I wanted to bring it up because COVID really has changed the world for a number of businesses. And I empathize strongly with those that have been unable to get revenue sources in. No way any of us could have predicted that, you know, major car rental companies have gone bankrupt, et cetera. Like, our worlds have changed. Air Canada, I understand 90% of their fleet is grounded somewhere. And like, clearly things have changed. So the projection process is there to help you assess a good situation you're in today, maybe, and how to get into a continuing good situation going forward. Maybe it's to assess the bad situation you're in today. How far do you think it will go before it becomes untenable? So I think that's all I wanted to say on the slides. Again, I appreciate everybody joining today, and we have subsequent webinars, again, all with the concept of planning the catch. Well, planning the catch is to say to land well into 21 with the COVID world around us. So please feel free to join subsequent weekly sessions. I'll be doing one in a couple of weeks on the merits of good bookkeeping, which is kind of a prelude to this one. But anyways, again, thank you for attending today. And if there's any questions, I'll gladly take them now. Stacy, do you have any questions coming in?
So far, there aren't any. A few people asked for the Excel spreadsheet, so I'm in touch with them. Other than that,
okay.
Yeah, nothing else.
All right. Well, then, I know there's an hour of time, but I don't want to dwell. Everybody's time is valuable. The cash flow forecasting of all the seminars we're doing, they're all useful. I'm a real proponent of cash flow forecasting for your business. That's why I originally developed this presentation in 2012 with Invest Ottawa and continue to do with them. If you're thinking of doing the projections, kudos to you. I think you're going to come out in a better way. The natural tendencies for all of us to hope that things will get better. It's hard to reflect that in a cash flow forecast or projection if the assumptions aren't there. So I'm asking just for the last time is to really be realistic when you're going through it, to not try to wish good results, but to document in your assumption what you think is realistically going to happen and where you're going with it. I think you'll have a better end result, even if it wasn't in the COVID world we're in now. So I'm going to sign off the webinar.
David, there's just
Yes.
one question that just came in.
Yes.
It says, what's your prediction of US Canadian exchange rate for the next 12 months?
I don't have one. I must admit, I find that's where in the way we see so many different businesses, I'd still say, you know, if my business depended upon it and I don't know which way it's going to go, I'd put it as a risk. I probably would rate it along with interest rates at a low volatility, meaning if I was doing my own for Logan Katz, this is not professional advice, it's me guessing that I don't suspect it'll change dramatically where we'll go to on par. But it would be the sort of assumption that if my business was predicated upon it, I would look at it on the variance on that month-to-month update. I would actively track it to see which way it's going. And if it's still going favorable, that I've got a competitive advantage, well then great. And if it's not, then I would start thinking. And I mentioned that condition would happen. So it was a client of mine that had a particularly strong consulting business into the US from Canada, from Ottawa. He the term pivoted. He went and changed his business model and started doing more with Canadian companies. It was really fun to be in business to see this sort of thing. So in your assumptions, if you're saying exchange is one of your value adds to how your success is, make sure you work out a pipeline, or at least a potential pipeline should it start to change. I have learned a lot in 40 years of public accounting I've done. That client I had a lot of respect for, still do, because he just changed his business model. He says, I'm going to start selling to these other customers in Canada more. And it was really a great thing to see. So I don't have a prediction for it. Interest rates, similarly, if you read just the business pages, a lot of this discussion comes up often. And I just follow the trends. You know, someone's saying interest rates are historically low. Are they going to go back to high single digits in the near future? I don't think so. I don't know, but if I was heavily leveraged on borrowing and that was a risk, I would probably work with my bank to lock in on as long a term fixed rate, low income, a low interest rate debt that I could. I would lock in today to just postulating. If I felt that was a risk in my projection process, I'd say go to fixed rate loan. It's better to know I got a little bit higher fixed rate loan than a variable, because if rates go up, I don't want to be exposed going down the road. So again, the projection process is to look at all your vulnerabilities. In terms of building out your customer flow also, there's a seasonality to every business. Some businesses have seasonality. I have a number of clients that sell a lot to the federal government. There still tends to be a buying push towards the end of March every year. March 21 would be a calendar date I'm thinking of. So you may end up with accelerated or deferred sales with lots of sales in those last 2 months of the government fiscal period, is to really think it through all the possible areas where some of your variances could come from and build those into your projection. Is that okay, Stacey, or is there anybody else?
Nope, that's it.
All right, well, once again, thank you for joining us. Thank you for joining Logan Katz, our firm, on these webinars. I hope you join on subsequent ones, and I wish you all a good day today.